becomes an issue. Or they said, okay, look, audit our financial statement, but your fee is going to be, let's say 5% of our profit after tax. That is the audited financial statement. So what does that mean? The auditor have to ignore all revenue manipulation, expense manipulation, to ensure that the profit after tax is as high as possible, because that is what will determine his own money, his own fees, or our own fees at the end of the day. So incentive-based fee arrangement could actually compromise auditors' independence and integrity, and this safeguard, the only safeguard to that is that the auditor should not accept an incentive-based fee or contingent fee arrangement. The fee should be based on the work done for the client. Concern over employment security could be a interest threat. The auditing members are looking for security. They are afraid that they are going to lose their job. So before you know it, they start fraternizing with the client's staff and things like that. Perhaps they want to cross to the client's company. So they are ready to, manipulate books to please the clients. Commercial pressure from outside the employing organization could also be a self-interest threat. Inappropriate personal use of corporate assets, could be a self-interest threat. Close personal or business relationship with the client could be a self-interest threat. It should not be encouraged. For example, the auditor is a family member of the auditee. Such an auditor should not be on the audit team. Holding a financial interest in a client or jointly holding a financial interest with a client, I think we've already talked about that. Undue dependence on fees from a client. When the fees from a client is becoming maybe up to like 15% of the fee that is being collected by the audit firm, then pressure will be on the audit firm to ensure that that audit is positive. And of course, gift and hospitality can create a self-interest threat. By the time you are collecting material gifts from the client, you become a slave, quote and unquote, to the client. You can become, easily manipulated by the client. So the auditor has to be careful to ensure that the audit team members do not receive material gifts from the assurance client. Alright, what about self-review threats? Like when I was talking about compilation engagement, I thought that sometimes the auditor may be called upon to prepare financial statements for the auditee. And in such a situation, by the time the auditor is reviewing the financial statement again, you're actually reviewing your work. Or in a situation whereby the client has outsourced the internal, the accounting department to the auditee. It happens sometimes, the client may have outsourced the accounting department to the auditing firm, and so it's the same auditing firm that is performing the accounting function. It's also the one that is also performing the audit. You are reviewing yourself, and it creates a threat to independence for the auditor. Alright, so all these can create self-review threat for the auditor, and there are a lot of safeguards you can put in place. For example, if the client has outsourced the accounting function to you, you have to create a wall between the guys that are working as accountants for the auditors and guys that are going to work as the auditors. So you cannot use members of the same team to do the accounting function and the auditing function. And like I've said before, when you perform compilation agreement, when you prepare financial statement for the client, the client must take responsibility for that financial statement. You cannot take responsibility as auditors for the financial statement you are prepared yourself. Okay. Then you have advocacy threat. Advocacy could come up in a situation whereby you comment publicly on future events. You know, there are some companies that do that. Even auditing firms, generally the big auditing firms, you see them on newspapers, you know, making analysis, maybe on international standards, making on comments on auditing standard, making comments on IFRS, you know. So if those comments are actually favoring a client, it could become a problem, because it's like you are advocating for that client. That's what it means. So it could backfire at the end of the day. Based on that, you can lose your independence. Situation where information is incomplete or where the argument being supported is against the law, the auditing firm could actually be advocating something that is against the law, which could backfire. Promoting shares in a listed company which is also an audit client is an advocacy threat. Acting as an advocate for an assured client, maybe in litigation, they sued your client and you are now acting as an advocate, maybe as an expert witness for the client. All these are advocacy threats that could impede the auditor's independence. Then familiarity threats. The auditors could become too familiar with the auditee. Alright. So we are a member in a position to influence financial or non-financial reporting or business decision as an immediate family member who could benefit from those decisions. It becomes a challenge. Alright. And situation like that should be managed very, very well. When there is a family member in the auditing firm that is related to a family, a person in the client office, ensure that that person is not part of the team. Long association with business contact influencing business decision. Like I've said before, an auditing firm auditing a company for 20 years. Forget, the independence has collapsed. That's why in Nigeria, they brought a safeguard. Once you audit for a bank, the CBN came out with that rule. You audit for 10 years, you have to resign. You have to let go for another auditing firm to come. Acceptance of gifts could also lead to familiarity threat. Over familiarity with the management of the organization could also compromise professional judgment. For example, an auditor has been in charge of an audit for the past 10 years. It's the same person that is heading the audit team for the past 10 years. There's no way professional judgment is going to be blurred. A former partner of the firm is a director or officer of the client. Alright? So you have a partner from the firm resigning from the firm and is now a director in the firm. It becomes an issue. How do you audit that director? Alright? So the only way is that you have to bring somebody that has a lot of power, a lot of authority to, and that is not too familiar with the person to be able to audit the job independently. Alright, intimidation threat also could also arise. The directors could threaten the auditors that, look, we are not retaining you next year if you continue like this. Alright, they can they can even threaten not to pay. Alright, they can threaten not to pay, they can threaten that they're going to, they can threaten you, they can threaten the auditors that they are not going to pay, they can threaten with that they're going to sue the auditing firm, they can threaten that they are going to reduce the fee. Alright, that they are, look, we can't pay up to this. So there are many intimidation threats that the auditors could face in the course of performing their job. So those are the 5 threats to independence or to ethical principles. And the safeguards, I've already started talking about them little by little. For example, there are some safeguards that are created by the profession. There are safeguards in the work environment. There are safeguards created by the auditor himself or herself. Safeguard created by the profession, legislation or regulation include education, training, experience requirement for entry into the profession. You can't just wake up and say I want to be an auditor. There's a process you go through, and that process would have deposited some ethical constraints into the auditor. The continuing professional development requirement, the CPE, I've talked about the MCPE requirement of ICAN. Corporate governance regulations is also there. For example, in UK we have the corporate governance code. It would be very good if you can review the corporate governance code of UK. It's also similar to what we have adopted in Nigeria. Alright, professional standards such as ISA, NSA is also there to guide the auditor. Professional regulatory monitoring and disciplinary procedures are also there. External review by a legally empowered third party. Alright, such as a government can. I've talked about the PCAOB in America. I've talked about FRC in the UK. Alright, in Nigeria too we have FRCN. Alright, and so on. All these are safeguards provided by profession and the government. What about in the work environment of auditors? Safeguards that are there. You have the employer's own system of monitoring and ethics and conduct programs. For example, you have internal training on ethics. You have mentoring program, in the auditing firm. Okay, so there could be a system of monitoring, system of institutionalizing ethics within the firm. Recruitment procedures, you have to recruit right. That's where it starts. Ensuring that only high caliber competent staff are recruited. Alright. Disciplinary processes if auditors go wrong within the firm. Strong internal controls should also be there. There should be leadership also within the organization, within the firm. The partners, the managers have to show leadership ethically. Policies and procedures to implement and monitor the quality of employee performance should be there. Policies and procedures to implement and monitor the quality of engagement should also be there. Alright, then documented policies regarding the identification of threats to compliance with the fundamental principles and so on. Communication of such policies and procedures and training to all the members of staff. Use of different partners and engagement team for provision of non-assurance services to assurance clients. Like I've said, you are auditing company A and you are also providing tax services for them. Alright, or you are providing IT services for them. This audit team must be completely different from this IT team. So you have to separate the teams. Alright, or else, fine, all of them are from the same firm, but if it's the same team, this is from the same pool, you are sending people to perform assurance service and non-assurance service, independence is going to be seriously compromised. It's a big challenge in auditing, which we have to handle with care. Alright, policy and procedure to stop individuals who are not members of the committee from inappropriately influencing the outcome of the engagement. That is, somebody from outside the team cannot just come and try to muzzle himself or her way into the team, or try to manipulate the team members to. Yes, we want to look at some review questions that can help us to go over what we have just learned. Question number 1 says, what are the limitations of rule-based code? Okay, remember we've said that the codes can be in two forms. It could be rules-based and it could be plain simple based. Rule-based means that all forms of a scenario that could happen to the auditor on the field will have could be imagined and will be compiled. Alright, and giving instruction to the auditor. In this scenario, you must not take bribe. In that scenario, you must not eat anything that is more than 10,000 naira. Don't collect. Okay, don't sign this kind of document, don't sign that of document. All right, that will be rule based compared to principle based, where everything is just summarized as general, to give a general direction to the auditor. Okay, so rules based have several challenges that we have discussed in the course of the video. Number one, as we said, is going to be highly voluminous, because you have to think of so many things. All right, so many information, so many scenarios that the auditor could face, and because of that, some facts, some key instructions could even be lost in the midst of the volume. It also happens like that when you have too much information. That's what they call information overload. All right, so you have too much information. That will be a challenge. Okay, that will be a challenge. Then number 3. Okay, there is no way. Actually, there is no way you can imagine 100% all the kind of scenario that the auditor will face. There are some institutions that will face that the auditor. What about in an emerging industry that people don't know too many? For example, cloud technology. Maybe a company is involved in a cloud is a cloud technology firm. All right, it's an emerging industry. So what does the auditor do in a scenario like that? Okay, so in novel cases, the auditor will be lost if we are using principle based, and people can always find way around, look for loopholes. People can do what is wrong when they know it is wrong. All right, but since it is not captured by the rules base, they will still go ahead and do it, and there's nothing you can do about it. Take them to court, they will still win you. All right, because it's not stated in the rule base. All right, even though they know. Okay, compared to principle base, when it tells you, for example, integrity, the auditor is expected to act with integrity all the time, regardless of the scenario, regardless of the situation you are facing. Once you didn't act with integrity, then something is wrong. So